So one of the things that we saw in the minutes as well was the Fed acknowledging these risks from trade tensions and then potentially weighing on growth. Where we stand now and following these latest Fed minutes, could we see any slower path of hikes from the Fed if these trade tensions escalate?
Well, I think the key word that you just said is if they escalate from here. I think the Fed path is based on what they see in the economic growth picture and in the inflation picture, and they recognize that trade tensions could eventually, or other political tensions, could have a real economic impact. But right now they're data dependent, and we lean towards the for side of the 3-4 debate, and I don't think these minutes change that.
At the same time, though, you acknowledge in your latest outlook the risks from these trade tensions, in particular between the US and China. You're still risk on, though.
We are. I think we recognize, there is a 20 to 30% chance of a serious escalation from here. But it's too early to give up on the global growth story. And it's too early to predict that this will evolve into a trade war. What we've seen is that the U.S. actions have generated a Chinese response. Now they're going to come together. None of these tariffs have really been implemented yet. We expect they will negotiate and come to a solution. And then, as you say, then there's the Fed policy and other central bank policy overlay on top of what happens on the political and fiscal side. So it is a little too early to see how the trade tensions themselves break out.
Mark, a very good morning to you. Have a great couple of days. Enjoy. It's always a great coalescing of minds. When we look at risk, the market, the world just doesn't look that risky. If we look at the Bank of America Merrill Lynch's chart, you can't see it, but I can tell you it's just bobbing along. There's so many known unknowns, if you excuse that pun. But if you look at the markets, Mark, the growth story is not interrupted. There's tax benefits in the United States of America. There's plenty of central bank generosity still out there. Vol is dropping in Bank of Japan. So that equity story still remains very firmly in play for you. Are you a buyer of these big sort of dips when they come, Mark? What are you hearing from the clients?
Yeah, well, I think that first, as you say, we're overweight in risk assets, we're overweight in equities, and we like the emerging market complex as well because we think that they will continue to benefit from the global growth story here. I think it is notable, our clients have certainly not panicked as we've entered into some of this political overlay on top of what is still a growth story.
Mark, the other thing that seems to be rather stoic, if not keep on going, is the commodity space. And oil has its own very unique set of geopolitical influences, but the commodity space remains robust so long as that global growth story remains there. How bullish are you on the commodity spectrum?
Well, I think that oil would be a place where we would focus a lot of what we look at on commodities. And there, I think it, too, reflects these different tensions that we're seeing and how we put them together. The global growth story remains strong, but now what happens with the Iran deal what the United States does there certainly is having an impact, and other kind of more acute crises around Syria are causing an impact as well. On the other hand, we have now seen a real increase in supply in the United States as well. So I think that $80 target is much more ambitious than what we see. Perhaps, a spike is always possible in this volatile asset class, but $70 might be the high end that we would look for in oil.
All right, $70 high end for oil. And we've talked about how you've sort of got a pro-risk stance, but how do you protect against downside risk? Because the very sort of positions that you're taking in your best case scenario look vulnerable if there is an adverse scenario.
Yeah, well, I think the first way that we want to protect our portfolios and clients is to really diversify globally, because I think some of these crises are more likely to have a local impact or a regional impact, and the global growth story could still remain in place. So that's first. And then I think we've done a couple of things like look to the Japanese yen as a stabilizer in times of crisis. And we also, recognizing, I think, that volatility would increase this year, we put some S&P puts into the portfolio to kind of mitigate the chance that one of those tail risks really comes to fruition.
In terms of volatility, we talk about a new volatility regime, but as I was saying earlier, actually we're kind of more back to normal after suppressed levels in the past year or so. So what does that mean? Does it mean you've got sort of quite a short-term chance to take advantage of volatility, or you see it getting higher and higher this year and next?
Well, that's an excellent question. Just to step back from a second, we're here with 11 trillion in assets under management to share views as part of our investment process, and that's exactly what we were talking about last night at dinner. Some of the managers, and there's several ways that could play out. So, first, one of the stats we looked at, it's something like there have been 27 days so far this year where the S&P 500 has spiked or fallen more than 1% versus only 8 in all of last year. Now, so that may feel like risk, but it is also opportunity. And I think we see that playing out in several ways. First, as asset allocators, one of the things we have to do is to decide to allocate to passive or active management. And in this kind of environment, there are some reasons why we're looking at active management and why some of the alternative assets we have in the portfolio have performed well, because they're able to take advantage of this volatility and some of the dispersion or changes in correlation that have taken place. So I think that's one of the things. And then what we do in our active positions is we try to look for more of those relative value plays and some of the currency plays that come from this.
Mark, I think one of the most enjoyable pieces that I read in the past couple of days, you've got a man on a mountain bike at the top of a mountain, a bit like what's behind you there, and it's downhill. You're talking about your European call. You say perhaps the Eurozone is still strong, but possibly the best is behind us. And you've altered your view. You shifted your Eurozone view. But I actually sat up in the chair because you've shifted it to a UK position. You're trading that Europe against the UK. Why? What's going on in your mind in terms of the soft data? Have we really passed the peak?
Well, one of the relative value trades that we had on was to be overweight European equities versus UK equities. And we recently closed that position because it's worked out pretty well this year. I think that, when you have a relative value trade, it's always a little on the one side, a little on the other. I think one of the things is that we think that the benefits that the UK index saw from that sharp fall in the pound have now flown through the earnings and are not going to be a boost. At the same time, on the European side, the PMIs have turned slightly, and so we're less confident that Europe is going to outperform the UK from here. And finally, on that point, I would just add that the UK index is more commodity-focused, oil-focused, and therefore that could also help the UK still do a little bit better versus Europe in that relative play.
You see, it's good to see your social media is effective. It manages to get me to sit up in 35-degree heat. We had Rick Reeder on there for about 30 minutes talking about the bond market. We've had the minutes. Let's circle back here because you also put out a note about who's financing the US debt. And we know the Chinese have a few wee bonds that they like to look after. But the demand, we did a trifecta story on the US. The PE's lower after Trump took charge. Demand for debt is the lowest since 2009 of the United States. What is the risk, Mark, of let's say, you moving much more towards the shorter end of the curve, as Rick has suggested they are doing in the bond space? Are your clients saying, look, I'd prefer 2-year paper rather than 30-year paper because there's only 0.6% difference between the two? Are you shifting to the shorter end of the curve?
In our allocation, we're not shifting that directly. In fact, we believe that some of these exuberant moves in the 10-year higher, like the push towards 3%, is something that we would actually want to bet against. And so we went overweight at 3%, betting it would, fall back a little bit. But really, I think you've hit on a wider force. Two points. The first is, at what point is the more risk-free return high enough to begin to pull money away from stocks, right, and other risky assets? And we think that process is starting, and that's why we anticipated and are seeing this higher volatility this year. So, that is something to consider. The other factor, though, I think, is when we talk to our clients globally, they really do not understand the United States that well, and their demand for dollar assets and investing in the United States with the twin deficits has also been shaken a little bit. And so that we don't think that the dollar can necessarily be as strong this year as some people.